I'm Georgia Williams with the Investing News Network, and joining me today is Adrian Day of Adrian Day Asset Management, and we're here at PDAC 2020. Thank you for joining me, Adrian.
Well, thank you for having me very much.
Anytime, it's a pleasure. When we spoke in New Orleans, we talked about a potential financial crisis, and you said that although a financial crisis wasn't imminent, the economy was deteriorating. And when the economy is deteriorating, any little thing can take it over the cliff. Is the coronavirus that catalyst?
It could well be. My friend Peter Schiff has a wonderful expression. I don't know if he came up with it, but he said it's not the size of the pin, it's the size of the bubble. And I don't think we're in a bubble. I disagree with him on that. I don't think we're in a bubble, but there is no question that the broad stock market, not just in the US, but in most countries around the world, is overextended, and parts of it are extremely overvalued. And so with that sort of scenario, but also a deteriorating global economy, anything can pop the bubble. Coronavirus could well be it. I mean, it all depends how it plays out, and I'm not a medical person, so it would be sort of foolish, really, and worthless for me to give my opinions on how it's going to develop. But it certainly will have significant impact. We know this. It'll have significant impact on global trade, and therefore on the global economy. Mm-hmm. And unless the world comes to grips with it pretty soon, it could well be devastating.
Right, and after Friday, there was been a lot of talk of central banks cutting interest rates, and that could happen as soon as, when the Fed meets later this month. Would that be enough to help the economy?
No, I don't think so. I mean, first of all, an interest rate cut does not in any way combat a virus, and the Fed has actually said that, but nonetheless will cut rates anyway. The problem with the Federal Reserve and the European Central Bank and the Japanese Central Bank and many other central banks around the world is that they have kept rates far too low for far too long, and therefore they don't have a lot of firepower left when they actually need it.
Right.
So, we're in Europe and Japan, we're basically at negative rates, and it would only take 3-4 more rate cuts in the U.S. before the U.S. Is into negative territory.
Right.
No, and the problem is people have said this analogy's been used so many times, but it is so true. Stimulus is like feeding drugs to a drug addict. Every time you give the patient a drug, they need more next time to get the same high. Mm-hmm. And I think the Fed has basically run out of ammunition.
That's a very interesting quote. I like it. How can investors manage a portfolio during the economic instability? Should they be diversifying while stocks are low, or should they just be focusing on gold?
I think the first thing when you have volatility, especially such as we saw Thursday, Friday, is you mustn't react to what's going on. And reaction on Thursday and Friday would have been panicking and dumping. That is the worst possible thing you can do. And similarly, when you have sharp moves up in gold, you don't want to just be piling into gold stocks at the high. I think one of the worst things investors do is they react rather than have some kind of plan and work on that plan. So to answer your question, I don't think people should be 100% in gold. I'm not quite that extreme. But I do think when you look around the world of all of the asset classes, of all of the markets, gold to me does have the best risk reward in the current environment. So I would certainly recommend a pretty high allocation for all investors. Diversification in my mind is grossly overrated as an investment attribute. Warren Buffett put it quite well when he said diversification is often an excuse for ignorance. Mm-hmm. When you think about it, your highest conviction stocks, whatever it is, you have highest conviction on gold and on Franco-Nevada, and you buy that. Well, the second thing you buy, by its nature, you have less conviction about. And the third and fourth and fifth, and eventually you're buying things that you either really don't know very well or you don't have a lot of conviction about. So I think diversification is overrated.
And we had talked a little bit about choosing stocks and whether you should, play explorers or producers right now. And
Yeah.
the opaqueness in the market is making it hard to choose which gold companies to even get involved with.
Sure, to a large extent, that's right. Gosh, I'm quoting all my friends today. Not that Warren Buffett is my friend, but anyway, Rick Rule has a great saying, which is, don't buy hamburger when the filet's on sale. And certainly on Friday and today, the filet, meaning, the good quality, large cap miners are on sale. So you always start with the better quality companies. And then what does better quality mean? Because producers, by their nature, are certainly not inherently better quality than juniors or exploration companies, by no means. But better quality to me means companies with good balance sheets, good managements, and companies that have consistently done what they have said they were going to do. And there are some great buys among the senior producers right now, among the royalty companies, as well as among the exploration companies.
Okay. And now we always talk about a gold price prediction when I speak with you. Where do you see gold going this year?
You sure we haven't run out of time? Well, I think it's definitely going higher, and that's not because of coronavirus, it's because of the macro environment and particularly the monetary policies being pursued around the world. That is extraordinarily bullish for gold. So coronavirus on tomorrow morning, WHO announces, oh, oops, we were wrong. We got it all wrong. It's just a regular old flu. Don't worry about it. Gold would fall. But by the end of the year, you didn't want a long answer, did you? By the end of the year, I think we could easily see 1750, something like that.
Okay. And will the gold-silver discrepancy be?
I don't think the ratio between gold and silver, or a lot of other ratios that people come up with, are really necessarily valid. The silver market has changed fundamentally over the last 30 or 40 years. For example, so much silver today is byproduct, whereas 50 years ago, much more silver, a majority of silver was primary silver. So when you have byproduct silver representing 75% of your production, byproduct from copper, well, gold, copper, but most importantly, lead and zinc, the lead miner does not respond to changes in the price of silver. He doesn't increase his production of lead because the price of silver goes up. And conversely, he doesn't close down his lead mine because the price of silver goes down. So anyway, because of those things, I really don't think it's such a valid thing to look at what gold-silver ratio was 100 years ago and say that's what it should be today. Having said that, I certainly think silver is very, very undervalued today. And some of the silver companies are just extraordinarily cheap.
Well, thank you very much for speaking with me
you.
today, Adrian. I'm Georgia Williams with the Investing News Network.